Okay, folks, this is Patrick Zielbauer from Infinity Futures. It's 3:30 p.m. on Thursday, January 25th. Thanks for joining us today. Let's do some risk stuff first. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So, folks, what we're getting at is only fund a futures account with risk capital. That means money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle. Be especially concerned with the terminology like day trade margin, especially for those of you who are new to futures. While we do offer flexibility when it comes to day trade margin, the use of day trade margin dramatically increases your leverage and therefore your risk. So as most of you know or will learn, leverage is a double-edged sword and it cuts both ways. All right. Another thing, sort of unique to this event is that this event is going to discuss the concept of trading correlated markets and also known as often called spreads. And there are good arguments to be made for spread trading from a risk perspective, but there are certainly increased risks at times related to spread trading. The correlations break down all the time. It happens without telling us in advance. There's been numerous times in my career in the 14 years I've been here where well-known spread trades have unwound in disastrous fashion, so to speak. So don't think that just because you're trading correlated markets that you are necessarily decreasing your risk. That's not necessarily true. We have lots of real-world anecdotal stories and conversations we could have with you about risk if it's something that you are unsure about. So just remember what happened yesterday. It doesn't necessarily mean it'll happen tomorrow. And always maintain your defensive posture and understand the instruments that you're trading in. And of course, Infinity, everyone here has a representative, all right, whether you're a client or not. We're all Series 3 registered. We can talk to you about risk. We are very objective when it comes to discussing risk. We don't sugarcoat stuff. So if you want to have a discussion about risk capital or about this type of trading in general, please, by all means, do not hesitate to ask, okay? Any questions about that? Please feel free to put them in. My name is Patrick Zielbauer, and I'm an AP or associated person of Infinity Futures. Been working here for almost 14 years now, since I graduated from college. Infinity has been a great place to work. It's been one of the few firms that is a boutique style firm that's been around for as long as we have. There are not many of us left. This industry has gone through a lot of changes, the low volume, low interest rate environment, the regulatory environment, the technology costs, and so forth. It has been a difficult road for a lot of firms, but we're proud to say that we're still here, going strong, growing. We got great things coming down the pipeline, and we do a really, really good job supporting this program, which is called Sierra Chart. So I'm going to minimize the web browser here just for a second before we hand it over to Thomas. If you are wondering, Infinity offers Sierra Chart, which is shown here, for free with 10 round turns every 30 days. So if you buy one, sell one contract 10 times in a 30-day period, then the fee that we would otherwise charge for Sierra is $20 is waived. So with a little bit of trading, you're not going to have a monthly fee associated with just the charts. So it's a very inexpensive account to maintain. We do a very good job supporting Sierra. It's a phenomenal application. And if anybody is curious, we have a simulator for free with live data. We can give you access, by the grace of Basecamp, access to this MQ vapor indicator that they gave us access to. Anyone who has a demo account or a live account, you can have it. Just contact us. We'll show you how to get it. A lot of you got an email about this already, so please feel free to follow up if you, excuse me, if you want to give it a whirl. We're certainly happy to help you. All right, so we do appreciate your interest and everything. And if you have questions about futures or trading in general, you want to give it a whirl, make sure you let us know. In this event here, we're going to have Thomas from Basecamp Trading here. So Basecamp is also known as MicroQuant. MicroQuant and Infinity and our parent company Transact have a long history. One of the things that's really unique about Sierra is that it is a phenomenal application to develop studies for. And one of the things we have loved about working with MicroQuant over the years is that MicroQuant has put considerable resources into developing really neat tools for Sierra, which our clients are using. So it just follows naturally that we're inclined to do events with MicroQuant and Basecamp because of their association with Sierra Chart. And they have done a really good job with some of these new studies, and they're constantly on the cusp of building these new programs that run inside Sierra. And given that most of our clients are using this program, it's just a very good fit. And so that is sort of the origination of the relationship between MicroQuant and Infinity, and it's evolved over the years to what it is now. And we look forward to a strong and prosperous relationship with them as they continue to develop for our program. It also just happens that a lot of the strategies that they're teaching sort of jive with the way we manage risk, and there are numerous synergies between the way that they teach trading and what we offer as a brokerage company. So that's kind of like the link between the two of us. Thomas has used our program. The other guys behind the scenes at MicroQuant have used our program. So we look forward to continuing to work with them. We appreciate Thomas being here today to talk with us. And that being said, I will go ahead and hand everything over. I'll be kind of hanging out in the background. So if you need something or have questions more along the lines of margins or brokerage or something, I'll be watching. Feel free to put it in the chat box, and don't forget to try the program out. All right. So thanks, guys, for coming. Appreciate it. And gals, Thomas, if you want to go ahead and take the screen, I will go ahead and make you a presenter, and I'm going to mute myself here, and you can take over.
Alrighty. Thanks, Patrick. Really quick, want to make sure you guys can hear me. So if you can, just give me a yes or a Y in the questions box so I know that we're good to go. I'm going to get the screen sharing up here as well. Excellent. Excellent. I recognize a lot of the names here. So good deal. And also, can you guys see my screen now as well? You should be looking at a picture of some mountains and base camp trading and an intro to the MQ SRT indicator. Good deal. Good deal. Well, first off, I want to say thank you to Patrick for letting us come in and hosting this today. We really appreciate it. And I'll tell you what, I tell everyone in the trading room and that's a member of ours and that I talk to that, look, Patrick is literally the best broker I've ever worked with. He will do anything he can to make you as successful as possible. He always makes himself available. So thank you, Patrick, for doing this. And again, if you're looking for a good broker, that's the man to talk to. So today we're going to be talking about a type of trading that we've been doing for years here at MicroQuant, and that is trading correlated markets with each other. He said he is the bomb. Absolutely. This is also known sometimes as market neutral trading or spread trading or pairs trading or correlated markets trading. And we're going to be more specifically talking about a couple different indicators that we created that were designed to help with timing trades into this type of a position, a market neutral or spread trade. But before we jump in with everything here, normally we go to the risk disclaimer, but Patrick carried that or went through that pretty good for you already. So if you want a copy of either one of these, feel free to send us an email or Patrick. We'll be happy to get it to you. And also we are required to show you CFTC rule 4.41, basically just saying, look, there's no guarantee that what we see in the past is going to happen again in the future. And although we're going to talk about some market neutral strategies as well as some directional strategies and weighting spreads and stuff, there's no guarantee that what's happened in the past is going to happen again. And we're not at all, like Patrick said, saying that there's no risk involved. There's always risk involved in trading. You can't get something for nothing. All righty. So with that being said, for those of you that do not know me, this is me, Thomas Wood. I'm the Director of Trading Operations here at MicroQuant and Basecamp Trading. Also run the futures trading room and have been for years. One thing I get all the time, oh, by the way, this is also my wife, Dora Blasso, or Dora Wood. One thing that I get told all the time is, wow, Thomas, you're really young. And I always find that funny. I say, yeah, I'm pretty young, but I'm fortunate enough to have been trading since I was about 13 or 14 years old. And I've already spent more time trading real money than most people will in a lifetime. And the only thing I've ever done in my professional career has revolved around trading and or education. And the reason I got started in this industry and in working in trading education and helping people is because the person that got me into trading in the first place was my father, all right? And my father, when he was first looking to learn how to trade, he lost hundreds of thousands of dollars following these quote unquote gurus out there that really had no business teaching what they were teaching, didn't know what they were doing. And I thought, you know what, that's not right. I wanted to become the exception and really wanted to actually help people and make a difference. So that's the whole reason I got into this industry in the first place. He said, I traded up for sure. You know it, Bruce. So where are you currently with your trading? I got a question for you. And you're going to be in one of three categories. Everybody is. The first category is losing money. So you're either losing money, breaking even, or making money. So 1, 2, or 3, where are you currently with your trading? Losing money, breaking even, or making money? Number 1, number 3, number 1, losing money, making money in options, losing money in futures. Number 1, number 3. Number 2, making money with Thomas. Good deal, Mike. Oh yeah, hey Mike. Losing. Number 3, making money, losing money. Number 3, or step by step 3. Okay, 3, 3, 2, 1, 2, 1, 3, 3, 2. Alrighty. So yeah, it's looking like the majority of people here are losing money or breaking even. So the next thing I want to talk to you about is, what are you after with your trading? And this is, I mean, I've been fortunate enough to work with thousands of traders from around the world, ranging from multi-billion-dollar funds that I've done consulting with, all the way down to just retail traders trading a couple $1,000 accounts. All right, but everybody is looking after the same thing typically, and they're going for consistency and profits, meaning income generation or steady account growth, or they're going for confidence in trade setups. They need help with becoming more confident in when to place a trade and holding on to that trade. So they want a proven strategy to follow. The other one that people are typically going after is a simplified approach. How many of you go, you know what, I look at my charts and there's so many different things going on, I can't even figure out whether the market's going up, down, or sideways. So most people are looking for an easy to follow system for trade identification. How many of you would agree with that, with these 3 points? Consistency in profits, confidence in trade setups, or simplified trading approach? Absolutely. Good deal. Yeah, who isn't after that, right? So what are we going to be talking to you about today? Well, what you're going to learn today is the fundamentals of spreads and mean reversion. So we're going to talk about what are spread trading, what's mean reversion, what is volatility arbitrage, what does all that mean? Big words for a very simple concept, right? Second thing we're going to be talking about is the SRT indicator. What is the SRT? How does it work? What are we looking for? How does that help us with identifying potentially high probability trade entries? And then lastly, we're going to talk about using the MQ Vapor, because as Patrick said, if you are a client of Infinity, we've teamed up with Infinity to give you guys the Vapor indicator, which is also another tool designed to work with trading spreads and trading market neutral strategies. All right, so today we're going to cover all this, but you got to realize that ultimately real change only comes from a long-term relationship. All right, you're not going to come in here to this webinar, buy an indicator, and then boom, all of a sudden you're going to be the most profitable trader in the world. It doesn't work that way. All right, we're going to talk about how to trade this, but you got to understand that it takes time, it takes practice. And one thing I always tell everyone to do, no matter where you're at, whether you're trading a few $1 million or trading a few $1,000, is start off simulated. When you're learning something new, trade simulated at first so that you can learn how the market moves. You don't have to lose money trying to learn this new strategy. And then once you understand it and you can make money simulated, then you transition over and you can make money live. Alrighty. So what is spread trading? What are we talking about here? Well, when we are trading spreads, we're identifying when two highly correlated markets that typically move together break away from historical norms. All right, and then we're trading that return to normal, also known as mean reversion. So again, we're taking two very highly correlated assets. It could be something like gold and silver, or gold and platinum, or RBOB and heating oil, or crude oil and RBOB, the crack spread, or something like your bonds, like a 30-year bond and an ultra bond, and trading these very correlated markets against one another. All right, so what do I mean by that, and how does that work? How do we make money with that? All right, because when we're placing a spread, we're going to be simultaneously long and short the markets at the same time. And since the markets are moving together, we should come out net even, right? Well, not necessarily, and that's where spread trading comes into play. So how do we profit from a spread trade? So let's say we have market A. And in this example, we're just going to say market A is RBOB, RB. All right, and then we have market B. We're going to say market B is heating oil. All right, heating oil and RBOB are very highly correlated. If you don't know what RBOB is, it is New York Harbor blend stock. It's essentially just unleaded gasoline. All right, and they're very highly correlated because they both come from crude oil. They're both derived from crude oil. They both move together. They have similar size, similar volatility. All right, so let's say market A and market B, RBOB and heating oil, typically move together, right? And this is how far apart they are. So let's say RBOB, hypothetically speaking, is trading at 10, and heating oil, hypothetically speaking, is trading at 5. Well, the distance between these two is called the difference, and the difference is just RBOB, the price of RBOB minus the price of heating oil. So in this case, the difference would be 5. Right? Now, let's say something happens, and for some reason, although these markets typically trade at a difference of 5, RBOB jumps up quite a bit, but then heating oil barely moves. So now the difference, or the distance between the two, the spread, has increased. Let's say RBOB is trading at 15. Let's say heating oil's still trading at 5, hypothetically speaking. Now our spread, our difference, is going to be 10. So it's increased. Okay, and what we do here, in this case, when we place a spread, we would be selling RBOB and we would be buying heating oil at an equal ratio so that we're equally weighted on both legs on either side of the spread in anticipation of this coming back to the norm. And if it does come back to the norm, let's say we come back to that 5 difference that it typically trades at, we then profit 5. Okay? Now, the thing about it is this does not have to always happen. Like Patrick said, there's always risk involved. You could have a correlation break. So keep that in mind. Now, the other thing is this is market neutral. And the reason I say it's market neutral is because since we're long and short simultaneously, and we are equally weighted on either side of the spread, it doesn't matter if the markets go up or go down. We will be making money on one leg and losing money on the other leg. Okay? So if it goes up, we expect heating oil to go up further faster because heating oil needs to catch up to RBOB. Or if the market comes down, we're expecting RBOB to come down further faster because RBOB moved without heating oil. Okay, so it doesn't matter if it goes up or down, we can still make money as long as the spread comes back in our direction. So I've been saying a couple different things, spreads, legs, etc. What does that mean? And let's get into a little bit of jargon. But before we do that, any questions about what spreads are and what the concept is behind this? So again, we're going long and short simultaneously, two highly correlated markets, in anticipation of the distance between the two, the spread, the difference, coming back together to make us money. Alrighty, so let's try and make this a little bit more clear. So here's some jargon that goes along with spread trading. Positive correlation, what does that mean? When we talk about two markets that are positively correlated, that means they are moving together. They both go up. If one goes up, the other goes up. If one goes down, the other goes down. All right. Negative correlation means they move opposites of each other. When we're trading spreads, we are typically going to be focusing primarily on positively correlated markets and trading the difference between the two. Alrighty. Notional value. What is notional value? Notional value is just the cash value of the underlying. So for example, a gold contract is worth 100 ounces of gold. Okay. Now you don't have to, you're not actually trading 100 ounces of gold. You're not putting up the cash for 100 ounces of gold when you're trading a futures contract of gold, but the notional value or the cash value of that contract, let's say if gold's trading at $1,200 an ounce, is $120,000. Okay, because it's $1,200 an ounce times 100 ounces. Alrighty, so the cash value. We want to make sure when we are trading spreads that we are weighting each leg of the spread, which is each side of the spread, equally based on the notional value. So if we're trading a $120,000 position in gold, let's say we're trading a gold platinum spread hypothetically. Platinum is only worth 50 ounces of platinum. So if platinum's trading at 1,200 ounces or $1,200 an ounce, you're only trading at a value of $60,000 notional. All right, so you would trade 2 platinum contracts to equal 1 gold contract. So you're equally weighted. You want to keep that spread equally weighted. That's what keeps it market neutral. Okay. Also the spread difference. You hear this word tossed around a lot. I've already talked about it a couple of times, the difference between the two. All that is the value of market A minus the value of market B. Again, with spreads, we're trading two highly correlated markets. We're taking A minus B. Alrighty, spread ratio. All spread ratio is the value of market A divided by the value of market B. Now, I personally typically will use what's called the notional difference for identifying setups. And what all that is we take the notional value, remember the cash value of market A, and then we take the cash value of market B, we subtract B from A, and that gives us the notional difference. Alrighty. So some more jargon you know is leg. When we talk about a leg of the spread, remember we're going long and short simultaneously in two different markets. So each leg is one side of that trade. Okay, so we have market A and market B. Market A is leg 1, market B is leg 2. When we say legging into or legging out of a position, that just means we're buying A first and then selling B second, or vice versa. Okay, so it just means you're entering one and then the other. A lot of times people ask me, well, hey, Thomas, I don't see these contracts. I don't see these spreads listed. How do I trade it? Well, you're going to be placing two separate orders. Okay, you're going to be buying one market and you're going to have another market over here in a different dome and you're going to sell market B. So it's two separate orders. Alrighty. Whenever we talk about quote unquote pair, so let's say gold silver pair or RBOB heating oil pair or RBOB heating oil spread, basically interchangeable. We're just talking about the two markets being traded against each other. If we say RBOB heating oil, that means market A is RBOB, market B is heating oil. Okay. If we say directional versus market neutral, so what does that mean? Directional means we have more weight on one leg over the other. And we do this a lot of times when we're hedging. So let's say we want to get into a position where we are bearish. Let's say we were bearish crude oil, but we wanted to hedge that crude oil position. We might sell 3 contracts of crude oil and buy 1 contract of RBOB. So we're hedging part of that position, and as that market moves in our favor, we cover that loss that's in RBOB and allow the winners that are in crude oil to continue to run. That would be a directional trade. So it's based on crude oil going down. That's how we make money. If it's market neutral, that means we are equally weighted on either leg. And let me show you how this works a little bit differently. Think about it this way. When you were a kid, you went up to the playground, you had a seesaw, right? If we are weighted, if we are in a directional trade, that means market A is going to be more influential over the direction of the profitability of that trade than market B. Make sense? If we are market neutral, that means market A, leg A, and leg B are equally weighted based on volatility and notional value. That means if it goes up or down, it doesn't matter because based on historical price action, they're typically going to move equally and equally weight each other. So we can make money going down, we can make money going up. All we're trading is specifically the spread. Make sense? So spread trading is known as the professional's trading strategy, and it seems really complicated at first, but it is actually very simple. And essentially all we're doing when we're trading a spread trade is we're trading two highly correlated markets against one another. So we're going to be long market A and simultaneously short market B. And it can be used to place both directional and market neutral trades. For example, the spread, this is called the BUB spread, which is trading 30-year bonds versus ultra bond, which is traded at a 1-to-1 ratio. That's typically going to be a directional trade. And why is it directional? Because the further out you get from the current date, the more volatility there is with interest rates, right? So if you're trading 30-year and then ultra bond is 30-year plus, that spread is going to be weighted towards whichever direction you are trading ultra bond. So let's say we're short 30-year and long ultra bond. That means we're technically net long bonds. Okay, so if we want to, where bonds might move, let's say bonds go up a point. All right, if you had been long bonds, you would be up $1,000. But let's say you instead went short the BUB, which is short 30-year and long ultra bond, which again means we are weighted on the leg of ultra bond, weighted towards the side of ultra bond. So we would be net long, basically. Our BUB spread might only increase $500. So we're decreasing the volatility, okay? And we're hedging our position. So we're taking the long, but we're hedging that position and we're decreasing the volatility. All right, and again, this can be used to place both directional and market neutral trades. Now, when we talk about going long a spread or short a spread, remember I just said a minute ago that if we say RBOB heating oil, that means RBOB is A and heating oil is B. If I say I'm going long RBOB heating oil, that means we're going long A and short B. So it'd be long RBOB and short heating oil. If I say I'm going short gold silver, short a gold silver pair, that means we're going short gold and long silver. All right. And again, we're going long and short simultaneously because you want to equal out that position. So we're trying to decrease volatility. So what are some of the pros and cons of spread trading? Well, some of the pros here and some of the reasons that people get into spread trading is because it lowers the volatility. Or instead of having a $1,000 move, you might have a $300 move or a $400 move on the spread. We're extending the duration. Because we're decreasing the volatility, it makes it easier to put on a longer term trade without having to risk a whole lot more money necessarily. It can be market neutral. So as long as we're not trading a directional spread, then we can trade a neutral position in the market where we can make money based on only the spread difference. And it doesn't matter if the market goes up, we can make money. If it goes down, we can make money. It also, depending on your broker, can be lower margin. Now, one advantage to trading with Infinity, they recognize the correct margin for this, for spread trading. So for example, trading the BUB, you're trading one 30-year and one ultra. Well, if you were just to put on one contract in each one of those markets, normally your margin is going to be about $8,500 or $9,000. However, CME says they understand that, hey, you're putting on a spread trade and that's lowering the volatility. So your margin for that is down around $2,000, so about 25% of what you otherwise would have had to put up. And not all brokers do that. And that is why, one of the reasons what we say Infinity is so good for spread trading. All right, now there's also some cons to it. There's still potential for loss. One thing that I've seen happen a lot is when people first come in, they start trading spreads, they get a lot of success very, very quickly. And they get winner, 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 over and over and over again. And then all of a sudden they get so used to having winners, they forget the fact that you're supposed to, there's still risk and it'll kick you in the teeth if you allow it to. And they don't cut off their losers fast enough and they allow one loser to wipe out 10 of their gains. So there's still potential for loss. You still have to have risk management. There's lower volatility. So we're not coming in with spreads and typically trying to hit the home run like if you just went long 10 contracts of gold because you're going to be long and short simultaneously. So we're decreasing the volatility and we're not going to try to hit the home run on every trade. It's all about singles and doubles over and over and over again. And then it's also harder to place stops. And Patrick and Infinity on Sierra, they've actually worked together to put together a program that will allow you to place stops and stuff in spreads. And I don't know any other brokers that allow you to do that right now. So you cannot place a stop because we're long and short simultaneously. You can't just say, well, I don't want to allow this market to go down 10 because let's say I'm long gold and I'm a short silver. Whoops, that's supposed to be GC. And I'm a short silver. And let's say these markets come down. Well, if we're short the spread and gold's accelerating down here, we couldn't have placed a stop here because if the market's coming down, we don't want to get out of one leg of the spread by accident. And then you're no longer in a spread, you're now in a directional trade, your margin goes up, your volatility goes up, your risk goes up. You know what I mean? So we can't just place a hard stop like you typically do with most trades that you're placing. Any questions about the basics of what spreads are? Before we move on and talk a little bit more about why do we use the MQ SRT and what the SRT is. Okay, and we'll do Q&A at the end as well. So why do we use the SRT and what was the SRT designed for? Well, the MQ SRT stands for Spread Retracement Tool. Remember, we're looking for these markets to go back to historical norms. So we're looking for a spread that's typically, let's say the difference which is A minus B, typically trades like this. Well, every once in a while, the spread will get way up here. Now, we're way outside of the historical norms, and we had a parabolic move one way or the other. So we want to see it pull back, and it's designed to alert us when these markets have parabolic moves one way or the other, or moves that are bigger than what we typically see. So it's kind of like an overbought, oversold tool designed specifically for spreads. So it's designed to identify when a spread has reached an extended point and is ready to retrace. It's based on the notional difference of each spread, and it's based on an RSI. So we're essentially taking an enhanced RSI and applying it to a notional difference. Okay, now it's created to help filter out false setups and help with time and entries with minimal risk. So trying to get us in the money quickly, make sure that we're getting in right at the right time so the market turns around and comes our direction very, very fast, which in turn allows us to risk less, so to speak, on our trades, because we expect it to come our direction very quickly. And if it goes against us, we can just close the trade right away and get out of it. So what's the SRT look like, and how do we use this? So this is the SRT. This is on the crack spread. All right, crack spread. This is just RBOB versus heating oil. And what you can see here, this is the SRT. This is the difference. Again, this is just A minus B. So remember how I said those two markets are moving together, and then the spread increases, and then it comes back together, back to norm. That's all this is. As the spread increases, this line's going to go up. As the spread decreases, this line's going to go down. So if we're short the spread, remember this is crude oil versus RBOB, which means market A is crude, market B is RBOB. If we're short the spread, that means we're going to be short crude oil, long RBOB. And we would look for this spread difference to come down. Okay, if we were long the spread, we would be long crude oil RBOB. And that means we'd be long crude oil and short RBOB, and we'd be looking for the spread to come up. All right, pretty simple, right? So if we look at this, how does the SRT work? Well, the SRT, when we get to the upper extended zone or get down to the lower extended zone, that's when it's time to be placing trades. So above 70 or below 30. So if you look at this, you can see it came down, extended to the downside. That means you'd be buying the spread right there, looking for it to come back up. Extended to the upside right here, you'd be selling the spread right there, looking for it to come down. Again, extended to the upside, selling the spread here, looking for it to come down. Extended to the downside, you'd be buying the spread right here, looking for it to come up. Again, buying the spread here because you're extended to the downside, looking for a bounce. And this is where I'm saying that there's risk, and you have to limit your trades, because you see here how this spread just kind of went parabolic to the downside, and sometimes things will happen. For example, who remembers Hurricane Harvey we had last year? That came in and it hit the Gulf Coast, and it hit right there where all the refineries are at in Texas. And when it shut down those refineries, it caused the price of RBOB to just spike through the roof. All right. So when that happens, your spread it'll break the spread temporarily. It'll break that correlation temporarily. And when that happens, this is why you got to have a stop loss in place, and you get out of the spread and you wait until the next setup. Okay. Makes sense? So pretty simple to understand. So let's take a look. This is another one. This is gold versus silver. So if we're trading a gold silver spread, right, we're looking to sell when we get extended to the upside, buy when we get extended to the downside. Once again, SRT is here, and our difference is here. We get extended to the upside here. Look at where that corresponds to the difference. So that means we would sell the spread. So that means if this line goes down, we make money. Well, what do you know? Down it comes. Extended to the downside here, right there. Immediately turns right back around, pops, and then turns around and climbs down a little bit more. Extended to the upside here, immediately pulls back down. Downside, turns around, heads back up. Downside again here, turns around, heads back up. Downside again here, turns around, heads back up. Now, you're probably going, okay, so how much money are you actually making on these? Well, if we're trading one spread in gold silver, you can see here these numbers, 46,384. This is a notional difference. So if we had a move from 45,500 to 46,500 up there, that's $1,000 per spread. So each one of these little bounces, this move here, this little bounce here, you're talking between $300 and $500 per spread on average. So again, much lower volatility, and you can see how this is a market neutral spread. So why is it market neutral? Well, you see how our spread difference is going up and down, even though these markets are just trending up. That's because we're long and short simultaneously, and we can benefit from the fluctuation in prices without having to pick the overall market direction. That's one of the reasons a lot of people come and say they focus on spread trading, is because they're tired of being wrong on picking the market direction. If you find that to be the hard part, come in and start trading spreads, and this is one way to do it. Okay, here's another example. This is the BUB spread. This is 30-year bond versus ultra bond. Now, remember I told you with the BUB, this is a directionally weighted spread, right? So whichever direction you're trading the ultra bond, if we're going short the spread, that means we're basically going long bonds. Or if we're going long spread, we're going short bonds. Okay, so again, extend to the downside here, pop right back up. Extend to the downside here, pop right back up. Extend to the upside, turn around, sell off. Upside, turn around, sell off. Downside, turn around, climb back up. All right? Pretty simple. Everybody understand the concept behind it and how this works? I'll show you one more example of using the SRT, and then we're going to go into a little bit more detail about the vapor indicator and how that works. So this is the S&P Dow spread. So we're looking at trading the S&P versus the Dow at a 1-to-1 ratio. It'd be long, if we're long the spread, that means we're long one S&P, short one Dow. If we're short the spread, we're short one S&P, long one Dow. Alrighty. Once again, it's all about the timing. Extend it to the upside, you're selling the spread, immediately pulls back down. Extend it to the downside, buy the spread, it bounces, and then turns around and heads lower again. And once more, this is where your stops come into play. I'm not sitting here telling you that you're not going to have stop losses, you're not going to lose money on some trades. Everybody loses money on some trades. That's all right. One thing that we teach at Basecamp is that it's all about that balance between reward risk and percent win. So you could have a strategy where you have a 100-to-1 reward risk ratio, meaning your winning trades are 100 times larger than your losing trade. So your average loss is $1, your average gain is 100. And you have a 20% win rate, that's a really good strategy to use. If you have a 1-to-1 reward risk ratio though, and you have a 75% win rate, that's a really good strategy to use. So it's all about balancing the risk and the reward alongside your percent win. Okay? So let me tell you a little bit more about how the vapor works and how we use that alongside the SRT. So vapor stands for volatility arbitrage percent R. And it's designed, it's based off of the concept of what a percent R indicator is, okay? And we design it to work once more on the spread difference or on the spread ratio. And it works alongside the SRT. You add it as an additional filter for potential trade setups. So as we add more filters, the probabilities of success go up higher, right? So this is one way of adding an additional filter. And again, we've teamed up with Infinity for this. Anybody that's an Infinity client can get the vapor indicator for free. Now, you use it alongside the SRT. It's not designed to be standalone. So how do we use it with the SRT? Well, we want to see the SRT extended to the upside, right? So there's the SRT at the top. Here's our difference in the middle, just like we had earlier. And this is, again, on the BUB spread. And then here's the vapor indicator at the bottom. So what are we doing here? Well, we want to see both the vapor and the SRT extended to the upside. And you can see it shifts much slower. Okay, it changes. The vapor does not start to move the opposite direction until way over here when the SRT is already getting extended to the downside. So why is this useful? Because what we do is we say, okay, if we're going to go short a spread, we need to see the SRT extended to the upside and the vapor extended to the upside. And then we use the vapor as a target for exits. So we wait until the vapor gets extended to the downside for our exit. So instead of buying this spread here, which is right there, we're waiting until all the way down here. And remember, the further down this difference goes, the more money we're making. So we're selling up here, and we're not covering or buying and reversing until all the way down here, and we're avoiding this choppy area in the middle because the vapor is acting as a filter. All right? So then we get extended to the downside on the SRT, extend on the SRT and extend on the vapor, which gives us the okay to go long, and look what happens. Right back up it comes. Once again, extend on the vapor and extend on the SRT, gives us the okay to buy, and we're looking at buying right here, and right back up we go. Extend to the upside again, looking at covering plus SRT, and you have a couple different balances here. You had the first one that was right there, which doesn't count because our vapor is not extended. The second one, that's an okay short, and it moved a couple $100 your direction before turning around and going the opposite way. And then the third one, we get extended right there, which is right there, ends up being the top, and you hold that all the way back down again. And you can see right here, this would be a short setup according to the vapor, and this was on the 10th or 9th, it looks like. And you can see extended there, extended, extended, so you'd be selling the spread. Make sense? So you can see kind of how it looks on the right-hand side of the chart. We go, is it extended here? Check. Is it extended here? Check. Is it looking extended here? Check. What's that mean? Sell the spread, and we look for the difference to come back down. Right? Now let's take a look at one more example with a vapor with crude oil RBOB crack spread once more and show you how it works. And then we're going to take a look at how you can get the SRT and how you can get the vapor. All right, so once more, this is crude oil versus RBOB. So if we're going long the spread, that means we're going long crude oil and short RBOB. If we're going short the spread, we're going short crude oil and long RBOB. Always doing opposites. So here we get extended to the downside on our vapor and extended to the downside on the SRT. And where are we buying that? Beautiful. Couldn't have been more perfect. Spike up, get extended on the SRT here, 1/2 profit, start scaling out of the position, and then you hold until you get extended on the vapor for the second half. Then up here, we get extended on the vapor and extended on the SRT. So we're selling, pulls back down a little bit, doesn't quite sell off all that much, a couple $100 per spread, turns around, starts to climb back up, you get back out. Same thing here, once more extended on SRT, extended here, extended here, sell it, come right back down. And these moves, if you're looking at saying, okay, well, how much are these moves in the crude oil versus RBOB? Well, once more, so this is at negative 13,000 up here. So move from the very top of this range down to down here is about $3,000 per spread. Okay, so again, we're decreasing that volatility drastically. Making sense? Now, you're not going to be placing trades every single day trading this strategy. You might have 1 or 2 trade opportunities per week if you're following 10 different spreads. So we're slowing down on number of trades we're placing. You're not over trading. You're waiting for these ideal situations to pop up, and then we're jumping on them right as the market's primed and ready. All right, so just to recap really quick, why do I use the SRT and the vapor? Well, it helps with consistency, it helps with timing, with identifying precision entries with lower volatility and spreads. And again, the timing aspect is a big one because the better you are at timing the trade, the easier it is and the faster you get in the money and the less money you have to risk. And then market neutral strategies. So you don't have to pick a direction in the market. You can trade the spread, and it doesn't matter if it goes up or down, you're hedged. And you can trade just the spread difference. So how do you get the SRT? Well, we're doing a special with Infinity today. You're going to get the SRT. You're going to get the SRT trading workshop. So how do you trade the SRT? And you're also going to get the bonus vapor indicator. Okay. Total value for this is about $2,000, but because we're doing this special with Infinity for Infinity clients, it's only $497. So all you got to do is go to bctnow.com/MQ SRT. Again, just bctnow.com/MQ SRT. You can get everything there for $497. So let's talk a little bit about, let me answer some questions here. How do you decide which market to go long and which one to go short? So again, remember we're looking at, if you're looking at the spread, yeah, bctnow.com/MQ SRT. So if we're looking at the spread, and let's say we're going short the spread, that means we're going to go short market A and long market B. So if we want to see our difference go down because we're extended to the upside, we're selling the spread, so we go short A and long B. If we're looking for it to go up, we go long A and short B. Okay? Let me answer some more questions here. Just send us an email. Good deal, Mike. Yeah, if you're having trouble with getting stuff set up, or for some reason your Vapor's not working, you can send us an email, support@basecamptrading.com, or you can email Patrick. Patrick will be there helping you. If you can't get this order link to work, feel free to email us, support@basecamptrading.com, or call us on the phone, 919-935-0010. How do we get the two charts to show simultaneously on the same screen like the upper chart? Well, if you are on Infinity, Patrick can actually send you workspaces with that pre-set up for you with all the indicators preloaded. Make it really easy for you. We're not trading option spreads. We're trading future spreads. So how does the Vapor relate to the SRT? It's two different methods of identifying extended markets one way or the other, of identifying when a market has moved greater than what it typically moves, okay? And we're applying it to a difference. So we're applying it to the notional difference chart, which is the value of A minus the value of B. And that's how we just determine, okay, this spread has moved further than it typically will move, and we look for it to pull back to the normal. So that's called mean reversion. We look for it to come back to the average, back to the norm. Do you have any other criteria to exit other than the Vapor indicator going to the other side? Yes, Ron, we typically look for between $300 and $500 per spread profit. Does this send alerts when it's extended? Absolutely, James. That's one of the great things about it. If you can't be sitting there watching it, you just have it run in the background and it'll ding an alert. When the market gets extended, you pull it up, say, oh, okay, I like this trade. You take it, or you say, no, I don't like this trade, and you don't take it. Now, again, don't expect to come in here and be in this webinar for an hour and now you're going to be an expert spread trader. It does not work that way. Take time to get the proper education on how to trade spreads. And in the workshop, that's one thing that happens in the workshop. It teaches you a little bit more about how to use the indicator correctly and what you're looking for, which trades to avoid, which ones to go for. Okay. You can use it on calendar spreads. It's not designed for calendar spreads, but you can, because if the spread gets way out of whack, it'll alert you. Calendar spreads are typically much less volatility. I don't even know what that is, Dirk. One-time cost or recurring? Nope, and one-time fee, only $4.97. What if I have the SRT? If you have the SRT and you don't have the Vapor, send us an email. We'll get you the Vapor. Yep, everybody on Infinity, you can get Vapor for free. Frank, I'm not on my trading computer right now, so I don't have my platform pulled up, so I can't pull that up right now. Again, yeah, they can work in counter spreads, but again, counter spreads typically have less volatility. The Vapor works only in Infinity. No. But you'll get it for free on Infinity. Use the notional difference. Is it not also a good idea to use SRT on internal spreads, such as August versus April? Yeah, it's called a calendar spread, Paul. And again, you can trade SRT on calendar spreads. And you can use seasonality. Seasonality comes into play a lot when you're trading calendar spreads, especially if you're trading something like RBOB or heating oil or gasoline or crude oil. I mean, those are very seasonal markets. Same thing goes for things like cattle, wheat, corn, soy, etc. Yes, Brian. You're looking clearly at ranging spreads. Do you also look at trending spreads? That's a great question, David. So some spreads will trend really well, especially when you get into seasonality and stuff. This is designed for mean reversion for ranging spreads. if a spread is trending, you're not going to use this because you're not going to use a counter trend. For example, it would be like trying to use a counter trend trading strategy right now in the S&P. You wouldn't trade counter trend to the bull market or in the stock market right now, right? You'd use a trend trading strategy when you're in a trending environment. Use a counter trend trading strategy when you're in a market that is more choppy or that is more range bound. What kind of profits can you achieve with neutral spreads? I cannot legally tell you that kind of answer, Kushal. I mean, there's potential for it. It's such a subjective question as well, because you could be trading 50 spreads at once from a position of 50 spreads, or you could trade a position of one spread. One spread might move $1,000. 50 spreads will move $50,000. That's an impossible to answer question, basically. Are you using MQ Vapor or Vapor Ratio? That's a good question. So when you are looking at two markets that are very close in price, for example, RBOB and heating oil are pretty close in price. It's like 1 point something 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 for RBOB, 1 point something something for heating oil. You're going to use the difference, the vapor. If you are looking at something like gold silver, where gold is trading at almost around 1,300 an ounce, and silver is trading at if I can't remember correctly, it's like 19 or something, then you're going to be trading the ratio. So if there's a drastic difference between the two prices of the markets, you're going to trade the ratio. If they're very close in price, you're going to trade the difference. Charles, you'll have to talk to your broker about trading it in an IRA. Do we give a list of all the correlated markets? No, but we give a list of a lot of them. If you go to, I mean, there's hundreds of different spreads you can trade. There's literally hundreds of spreads. Just go to the CME's website. You can look up all the different spreads that there are. And there's all kinds of things ranging from weighted spreads to spreads that have really crazy ratios and stuff. It really depends on what you're trying to trade. But there's plenty of options. Okay, let's see. Do you have to have certain type of charts up and moving, i.e. range, tick, time, range, Renko? You're typically looking at a time chart, but we're not basing this off of the price chart unless you're trading a directionally weighted spread, and then you're basically taking a hedged long or a hedged short. We're basing this off of the difference, the value between A and B, that spread, distance between the two. When you get the indicator, send us an email, and we can send you a cheat sheet with different spreads and their ratios, some of the most commonly traded spreads. Is the Vapor a whole new indicator besides the SRT? Yes, Vapor and SRT are two 100% different indicators using 100% different math to determine extended markets. If your target profit is between $300 and $500, and what's your max loss? We will risk between $300 and $500 on a spread. And again, the reason we can do that is because of the way that we're timing the entry. Keep about a 1-to-1 reward risk ratio. We have about a 75 to 80% win rate. Alrighty. A few of them, John. Send us an email. This is specifically for Infinity. Are all of our trades based on an hourly chart? No. We'll drill down and use a 5-minute chart to time an entry. We might look at a 240-minute chart if we're looking for a longer term spread, or a daily chart if we're looking for a longer term spread. You can use basically any time frame you want. The longer the time frame you're looking at, the longer the period of time you're looking at staying in that position. The Vapor is free with Infinity. If you want the SRT, it is $497. And that comes with the workshop on the SRT indicator itself, as well as the Vapor. All right, everybody. That's going to be about it for today because we're running out of time. So Patrick, my friend, thank you for having me on today. We appreciate it. And if you have more questions, that have not been answered, send us an email, support@basecamptrading.com, or call us 919-935-0010, or you can talk to Patrick at Infinity. Yes, we do. We use these indicators in the trading room. Absolutely.
Excellent. Well,
All right.
thank you, Jonathan. I appreciate that very much. Thanks for your time today. I'm going to take the screen back for a moment just to show some people some charting things here in a minute. There were a lot of questions about this study, so give me just a second here to bring it up. I appreciate you coming by.
All righty. Thanks, Patrick. Have a good one, everybody.
Sure thing. Take care, man. Thank you. Okay. Okay, guys, so you should see the charts here again on my screen. And so this is what Sierra looks like. And what you'll basically see is at the top there are a bunch of tabs. And these tabs represent each one of these spreads that Thomas is talking about. So like this one is RB minus HO. This is wheat, corn and wheat, et cetera, et cetera. So if you are interested in general in this type of trading, then let us know. We'll fire up a trial of the program. It'll have live data. It's good for 30 days. You don't have to pay us any money or open an account. It's 100% free, and there's no personal information. You don't have to give us your social security number or open the account or anything like that. But we are a direct head-to-head competitor with companies like TradeStation and Thinkorswim. There are some benefits from a price perspective and margins perspective to work with Infinity. And just our position, for those of you who are unfamiliar with us, generally speaking, is that if you're going to trade futures, do it with a company who doesn't treat it like a side project. And our position, again, it's all about risk. We believe this is a risky play. We know that what happened yesterday, might not happen tomorrow, and we know that our clients are trading products that are highly levered. And considering the risks involved, we believe that if you're going to do this, you should consider working with a company who is really focused on it instead of one where it's one of their 8 or 9 different businesses that they're running. So there are some infrastructural advantages to working with us over some of these other places. There are some cost and margin advantages. There's definitely some service advantages. We just feel we're a lot more nimble and in tune with what people are looking for. And that is generally our position. So we certainly encourage you to give us a try. For those of you who are live clients, thanks for coming and listening to our webinars. I'm still doing my Monday charting events. For those of you who are interested as well, you can find them on our website. I started doing those again a couple weeks ago. We'll be doing one every Monday on Sierra Chart this year. So please feel free to attend. All right, I appreciate it. Thanks everybody for coming. Have a great night. We'll see you next time. Thanks so much. I'm going to read some risk stuff and then we'll close the room down. Thank you, folks. All right, folks, trading futures, options on futures and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks, thank you again. Have a good night. Bye-bye.